Greetings to all the attendees. Welcome to the webinar series of Advait. At Advait, knowledge has always been one of the core pillars and backbone of what we do. We believe in sharing it actively, and with this objective, through the webinars, we try to bring curated, relevant insights for the audience from our space. Our previous webinar series was on Strategic Finance Office, where with a total of 90 minutes across 3 sessions, we covered from the concept of a strategic finance office, clarity on certain misconceptions, its role and impact, and importantly, all these have been brought to life through real world case studies from decades of our experience. In together, the SFO webinar act as a practical playbook and aids in guiding the businesses. If you feel it's relevant to you, you can always watch them on YouTube, where we have streamed the recorded ones. Well, without any delay, let's kick off the current webinar series, which is NRI Guide to India Property Transactions. And today's session is exclusively about everything you need to know as an NRI while selling India properties. You can leave your questions in the chat box. If time permits, we will answer in this webinar. Otherwise, we'll take them later and make sure that we address them. As we are all aware, in today's era with rising global mobility, many of us are living in abroad while still managing properties of our native. It makes a greater difference if you see for a resident of India selling an India property versus an NRI selling an India property. And that's where the criticality lies in understanding how the key provisions shift gears the moment your residential status changes. Before we dive into pitfalls, practical challenges NRIs currently are facing, and the way forward with practical insights, which Krishna sir will be deep diving into, let's first walk through a sequential foundational context. So, myself, CA Shilata Bhatt from Advait, and I would like to welcome Krishna sir before I begin this webinar. Welcome, sir.
Thank you, Shrilata.
Yeah. So, first, let's talk about the taxability. As an NRI, you need to know that any gain from selling a property located in India is taxable in India. Your country of residence doesn't change this. The income arises in India and it's taxed in India. Now, to know how much tax you actually need to pay, you first need to arrive at the gain that you have made. And that gain is nothing but your sale value minus cost of acquisition. Things will not be straightforward as there are lots of provisions impacting at this level. For example, when we say cost of acquisition, it is cost you have incurred for acquiring the property. But imagine in case of inheritance, you wouldn't have incurred any cost. But the law directs to consider cost of acquisition of the original owner for calculation of your gain. Let's take another example. If the property is old, you have provision in the law to appoint a registered valuer and get a stamp duty valuation done instead of relying on very old prices. There are also provisions in relation to cost of acquisition where you can apply indexation benefits in certain eligible cases. And indexation is nothing but adjusting your cost of acquisition for inflation. Now, once you arrive at your sale value and cost of acquisition, the difference becomes your gain. And this is where the real impact lies. If you have held the property for more than 24 months, the gain enjoys long-term treatment with a current flat rate of 12.5% of tax. But if the holding period is up to 24 months, it would be considered as short-term capital gain, which gets taxed at regular slab rates based on your income levels with applicable surcharge and cess in both the cases. So with this understanding in place till now, let's move to the interesting aspect or segment of this webinar, which is practical challenges and how to tackle them through practical checklists from Krishna sir. Over to you, sir, for the insights.
Yeah. Thanks, Srilata, for setting the context on some of the legal provisions. To begin with, like Srilata mentioned, if there is an immobile property that is situated in India, the immobile property could be in the form of land, it could be in the form of land and building, it could be in the form of, let's say, a house, an apartment, a flat, or it could be in certain cases even tenancy rights, leasehold rights, etc. These are all covered as immobile properties for the purpose of taxation in India. Despite the double tax avoidance treaties that India has with in numerous countries, over 100 countries to be specific, in all the situations, in all the treaties, it's very clear that any gains that arises from transfer of a immobile property is always taxable in India. While doing this, like Shilata was mentioning earlier, there are two important aspects that comes into play. One is what is the value on which tax is computed and how that is computed. Second is what is the rate of tax. Firstly, in a situation of transfer, let's take a transfer simpliciter where there is a buyer and where there is a seller. And a price is fixed between the buyer and seller for the transaction. Now, the market forces typically determine what should be the value at which this consideration is fixed. Let's say I'm selling my property, I'm a non resident, I hold property in India, I'm transferring it. The market forces of demand, supply, etc., will determine the price at which I am allowed to fix a price with you as a buyer. But because this is a regulated industry, which is transfer of immobile property in India, what also happens is that the tax law says, in case you are transferring the property at a value lower than guideline values, stamp value, or circle rates, as they are called in different states in India, the higher of the two, either the value at which that actual transaction is taking place or the value which is used to determine the stamp duty, is deemed as the value at which you will have to compute your capital gains. So what does this mean? Let's take a example. Let's assume that somebody is selling a property in India at a 1 million INR, and let's assume the value for the purpose of stamp duty, which has been fixed by the local authority or the government, is 1.5 million INR. In such situation, though you are transferring the property at 1 million INR, 1.5 million INR is considered as the value at which you will have to compute the capital gains. That becomes your sale consideration. It is deemed as your sale consideration, deemed under the law. Then coming to the cost of acquisition, like Srilata said, multiple situations can emerge. Let's say I, as a seller, could be the one who has bought this property. First situation. Second, I, as a seller, could have bought the property and constructed a building on top of it. Second situation. Third situation, I did not buy it. My parents had bought this property. I inherited it from them, or they gifted it to me during their during their lifetime. Or one of my brothers or sisters had bought this property. They gifted it to me. So all these possibilities exist about how the ownership might have come to me before I am selling this property. Or there could be a situation where I have bought this along with my spouse. I have bought this property along with my wife or kids. So in all of these situations, the way the sale consideration and the tax is determined is starts getting more complicated. The sale consideration per se, one is that, like I mentioned earlier, it's the transaction value or the value which is fixed for the purpose of stamp, is how it is fixed. But on whose hands and how is this computed is dependent on who is the legal owner at the time of selling it. If I am the legal owner because it was gifted to me or I inherited it, etc., then the capital gains taxation is in my hands. If me and my spouse owns it together, then the tax has to be computed in both of our hands. Unlike in some countries, including US, where a joint return filing between the husband and wife is allowed, in India there is no such concept of a joint filing that is allowed. So each of the owner of the property have to compute their taxes and offer it to tax separately in their tax returns. For doing this, of course, the one of the critical parts is having a permanent account number. You need to have obtained a permanent account number, even if you don't have one. You've been a non-resident for quite a while now, but you own a property in India. At the time of sale, you are mandatory to obtain a permanent account number. Permanent account number is a tax identification number, which is issued by the tax department in India. Now, coming to the cost, one, if you have acquired the property, your cost of acquiring the property becomes your cost that is tax deductible. If you acquired and improved the property, that is, you built something on top of it, you paid for some betterment of certain things. Let's assume the property was litigated at the time you bought it. And to clear the litigation, you went through a certain court proceedings. You arrived at a certain settlement with a litigant on that side. So the cost can include all of these. But let me put that with a word of caution that for any cost that you want to claim as tax deductible at the time of computing the capital gains, a suitable documentation, a proof of incurring these costs becomes extremely critical. Now, one might ask a question, somebody bought this property about 50 years ago. How would I, and there was construction that happened, let's assume 30 years ago. There was a repair and renovation that was done about 20 years ago. And how do I keep track of all of this? I don't have any documents which prove what are my costs. Now, in such situations, what the law says is that firstly, any property acquired prior to 1st of April of 2001, the law allows that the value that the stamp duty authorities had fixed around the time of 1/4/2001 in India is deemed as the value at which this property needs to be considered. The cost, you get a cost step up to that extent to state that. Let's assume a property was purchased in 1980. In 2025, this property is being sold by you. The law allows you to consider the cost that prevailed, or rather the value that prevailed as on 1/4/2001 as the cost of acquiring this property. But again, multiple challenges emerge. The value for the purpose of determining stamp duty is typically given out only for the land. It's not given out for the building. But a mechanism will be prescribed in some states, like in the state of Karnataka, in the state of Maharashtra, in the state of Telangana. There are methods which are prescribed as to how the value of the building has to be arrived at. Now, the question comes, who is going to determine how this is to be done? Again, the tax law allows a certain leeway here. It allows certain people called as registered valuers under the income tax who could be appointed to determine value of the property based on these formulae, and such value which is certified by them could be considered as the cost of acquisition. And for the purpose of a simple land, the stamp duty value, where do you get it? Typically, sub-registrar's office, tehsildar's office, depending on where this land is situated, whether it is in an urban pocket anywhere in India or a metropolitan authority in different states, are the ones who are authorized to register the transactions. And those authorities' offices will consist of these records of the value that prevails as on 1/4/2001. And most of the states in India have also digitized these valuations. Pretty much these are also available online. But some guardrails that you will have to make sure that you keep are that in case there is ambiguity in valuation or there is an improvement that took place on that property subsequently, it is recommended that one appoints a registered valuer and gets a valuation clearly written down, crystallized, so that if tomorrow the tax returns go for a detailed audit by the tax authorities, you have enough documentation and proof, and you can prove your bona fides of how did you determine the cost at the time of computing the capital gains. Now, there are also situations where to sell the property, you might be incurring some cost. You might be paying a brokerage to somebody who helped you find a buyer. So these costs are also allowed to be reduced by at the time of computing the capital gains. Now, a typical situation also happens in India is that in a lot of places in India, particularly, is that when you go to, let's say, register a property of sale currently, the value at which stamp duty could be computed is ideally lower than the market value, because the government would have notified these values maybe a couple of years ago, and those values have remained as such. Now, the stamp authorities, there are two things that emerge here. One, the stamp authority is good enough if you pay stamp duty based on the values which are there, which are prescribed over there in the valuation that is certified or announced by their office. But the income tax tells that you will have to pay taxes on the actual transaction value. Now, we have seen situations where people try to sort of avoid the stamp duty payouts and try to register the properties at value which is equivalent to the value which is there prescribed under the stamp authority. The next question comes, how do you exchange the rest of the consideration? Let's take an example. Let's say the stamp value of a property is 1 million Indian rupees and the actual transaction value is 1.5 million. Now, on the 0.5 million, which is excess, one may say that I will avoid a 6, 7, or 8% stamp duty, so I will not want to record that as a part of my sale document. But I will still exchange the consideration in a legitimate manner. I will use all the banking channels to legitimately exchange the consideration. In such situation, income tax authorities have the right to go back and deem that the entire 1.5 million is your capital gain value. At the same time, you should also be very careful that if such a transaction is gets to the notice of the stamp authority can also levy penalties for under declaring the transaction and levy penalties on that. So it is important that at this stage one takes suitable guidance from financial experts and legal experts to ensure that you don't get unnecessarily stuck in a situation where you are attracting the wrong eye of either of the authorities. So once the capital gains is computed in the manner that I just now explained, which is the consideration that you sold it for, less the cost that you incurred towards selling the property, which is, let's say, a brokerage was paid, minus the cost of acquisition, the resultant is called as the capital gains. Based on the period of holding this property, in excess of 24 months, if you have held this property prior to the date of sale, it becomes a long-term capital asset, attracting a lower tax rate of 12.5% currently. If it is shorter than 24 months, then it is a short-term capital asset, attracting a tax rate which could be as high as 30% depending on the slabs that are there. In India, as you may be aware, there are slab-based taxation. There are different tax rates for different slabs. So this is in sum and substance how the computation of capital gain has to be done and what are the tax rates. Shilata, over to you.
Yes, thank you, sir. So now we have covered and understood certain impacts considering sales, cost of acquisition and gain, and taxation impacts. But the next layer that we need to look at is the TDS. TDS, a tax deducted at source. It is simply a tax that the buyer deducts upfront when making the payment to you. It's very important point that for residents in India, there are threshold limits below which TDS may not apply. But for NRIs, there is no such threshold. Even small value property transactions trigger TDS when the seller is an NRI. But the whole point of TDS is like whether the deduction is actually appropriate. It depends on entirely how your tax position is structured. For example, you might be planning to reinvest the funds into another residential property, or you might be planning to reinvest funds in eligible bonds and claim exemption from capital gains. There are provisions which will allow, obviously with conditions on timelines and all. Imagine another scenario where through indexation in certain eligible cases, your cost might increase and your taxable gain may substantially reduce. But the buyer, unaware of your exact tax position, as per the law, they are required to deduct TDS at rates in force, which might be far higher than what is relevant for your tax position. To curb this mismatch, the law provides LDC mechanism, which is lower deduction certificate, through which the department allows TDS at the correct rate aligned to your tax position. So this ensures there is no unnecessary blockage of funds, there is no excess deduction, and no long refund cycles as well. But if you see in practice, this process can bring its own set of confusions and coordination challenges. Krishna sir, request you to throw some light on this area.
Yeah. So there are 3 points that Srilata brought out. One is the point on exemptions. So the point on exemptions is that once a immobile property is sold, and if it is a long-term immobile property, that is, which has been held for over 24 months, the income tax law in India allows, based on certain conditions and thresholds, that if you reinvest it into something else, a residential property or an eligible bond, your capital gains are exempt from taxation. This is the first point. So one has to, based on their financial needs, their interests about paying tax or repatriating the money, etc., might have to consider the exemptions. Second, there is a withholding tax that the buyer has been mandated under the law. This is a mechanism for doing two things. One, reporting to the government that such a transaction has happened, and an advance payment of tax on such transactions. If the transaction is happening between two residents in India, a resident is a buyer, a resident is a seller, it's fairly straightforward. They're based on certain thresholds. A 1% withholding tax has been prescribed. But when the seller is a non-resident, what happens is that the law says that buyer is obligated to compute the actual income of the seller, basis that deduct the actual taxes that he has to remit to the government. Now, what does this mean? This means that the buyer not deducts the taxes on the value that he is paying you for. He has an obligation to determine the cost that you are allowed to claim under the tax law, compute the capital gains, and apply the right tax rates also, depending on whether it's a short-term asset or a long-term asset for you. Typically, what happens is that the buyer may not have this information or may not make the effort to get all this information. Then they will go ahead and apply a straightforward, either a 12.5% tax rate or a 30% tax rate straight away on the value that they are paying to you. If they don't do so, what will happen is that they will be penalized by the government for not doing their bit of the obligation correctly. So in order to be cautious on that front, they may end up deducting a higher tax rate on the sale consideration itself without considering the cost and the exemption that you may have to claim. In such situation, like Srilata mentioned, there is a mechanism to go before the tax authorities and apply for a lower withholding certificate. The interesting part is lower withholding can be applied either by the buyer or by the seller, depending on convenience and negotiation that has happened between the buyer and seller. There are both routes possible. Multiple practical coordination challenges exist in this, and this is also time consuming. This may take anywhere from 30 to 40 days. So while planning your sale transaction, apart from negotiating on the value, the timeline on when they have to pay you, when the registration is going to take place, etc., You'll also have to plan when is that you will be able to consummate the transaction, depending on whether you want to apply for a lower withholding certificate or not. What also becomes essential is that if it's a resident to resident transaction, there is no need to obtain a specific number called tax deduction account number or a TAN number. But when the seller, that is you as a seller, are selling a property and you are a non resident, the buyer is obligated to obtain a tax deduction account number and then apply the withholding tax that they are required to do. So that will add up a few more days into the entire planning. So that on a practical scenario, to obtain a TAN number, it could take anywhere between 7 to 10 days. To obtain a lower withholding certificate, it could take anywhere between, let's say, 30 days. So all in all, you will have to plan the transaction in such a way that you keep this 40 to 45 days buffer by the time you conclude your negotiations and by when the transaction can actually take place. Otherwise, the buyer is free to go ahead and deduct a higher tax, and your ultimate tax obligation in India could be much lower because you get a cost reduction or you are actually claiming an exemption. But you end up having, suffered a large withholding tax, and you'll have to file your tax returns at the end after that financial year is ended. Let's take a situation. In December of 2025, you sold a property. In India, the typical financial year, as you all may know, could be April to March. So the financial year in this case ends in March 2026. The due date to file tax returns in India is up to July of 2026 for individuals. And the tax returns typically get notified in the end of May, first week of June. And the tax returns are filed, processed, and refunds are granted in a time period of 3 to 4 months. So you're essentially looking at 6 to 7 months from March, and depending on when the transaction took place, you could be virtually looking at period of maybe 11 to 12 months from the time you actually sold the property, assuming that you sold it in April or May of that financial year. So it is important to plan this entire thing very carefully, keeping these thresholds in mind and these timelines in mind while selling a property. We've also seen practically some buyers stating that, look, let's not declare you as a non-resident, you as a seller as non-resident. We will straight away go ahead and do a 1% withholding, and then we'll be done with it. Two problems will happen. Number one, your passport clearly states that you entered India on a particular date, and you are risking it too much just to avoid withholding tax. But eventually, you may get unnecessarily penalized for not declaring it correctly. Second, the buyer will also be issued notice of not deducting the tax correctly, and then they may come back and start telling you that, look, I have got a notice now. I deducted only a 1% withholding while I had to do a 8% after considering your costs and all of that. Now pay me back the 7%. I will deposit it with the government. You can claim it in the tax returns, etc. Gets too messy and cumbersome. So in order to avoid all of this, it is very important to follow the sort of procedure that I narrated so far, to ensure that you follow this thoroughly while selling a property in India.
Thank you. Thank you, sir, for your insightful inputs. What I can summarize through our entire discussions is, yes, there are practical challenges. There are multiple provisions affecting these transactions. But if you are aware of the sequence, key touch points, with the right guidance and timely actions, the entire process can be managed smoothly and completely under your control. With this, we have come to the end of this session. I would like to thank you all for joining the session. We hope the session was useful and gave you the required insights that you were looking for. If there are any questions, you can reach out to us at support@advaititech.in, or also you can leave your comments on our YouTube channel where we will address them. While this session was exclusively on selling of India properties, we have our upcoming webinars on buying India properties by NRIs, followed by insightful repatriation and FEMA perspective in this webinar series. Stay tuned until then, and in the meantime, if you want to know more, you can visit our website, read our blogs, and subscribe to our newsletters and stay updated with key finance insights. Thank you again for all of you.
Have a good day. Thank you so much.
Thank you so much.